Happy Tuesday, everyone. Hopefully, we've all recovered from our wonderful Christmas meals and all of our gifts and a little time off of work. So if you're at home, hopefully you're choosing to give a little bit of time with us here, share a little time with us here on a Tuesday night. Have a great group of experts, as always, from around the country. We've got Jerry Avila, who is in Arizona, but covers most of the West Coast, California, Texas, Colorado. Randy is in the great state of Texas, and Thomas Sloan in the New York, New Jersey area. And I'm out here in California. We're going to cover something really important. We're coming off of the Christmas season here. A lot of spending, probably the biggest spending time of the year. And a lot of that goes on credit. And we're going to talk about credit scores and specifically getting a VA loan when you have a lower credit score. So in the context of tonight's conversation, we're really talking below 640 and then probably below 600, really, especially because that's where it starts to get a little bit more, not difficult, but just a little more interesting and a little more reliant on an expert to walk you through that process. So I want to give a little bit of context before we jump into what an average credit score looks like. A lot of people think, hey, 680 is an average credit score. And that was true about 10 or 12 years ago. In 2011, the mid score or average credit score for an American was 688. Most recently, the FICO released the numbers in April, and that was a 718. So we are 30 points higher over the last 12 years. If you want to be average, you have to bump that score up over 700. And right now, 63.7% of Americans have a 700 credit score or higher. So really, when we look at it, that 670 to 739 is the range that FICO describes as a good credit score, but that's really an average credit score. Not bad, but it's really an average score. With that, another one here, a couple of numbers that I thought was fairly interesting. Optimal Blue does a mortgage market monitor every month, and they kind of break it down by different types of loan. So we're going to talk tonight about low credit scores and VA loans, and VA not having a credit score requirement, but the average score that Optimal Blue is reporting on VA loans right now is 710. The last little interesting piece of trivia we'll go with tonight is by generations. Older Americans tend to rely less on credit and have better credit scores. So Gen Z has an average credit score of 679. Millennials goes up to 687. Gen X up to 706. And then we get to the people that are serious about their credit. Boomers are up at 742 and the silent generation at 760. So it just gives you a little bit of context of where we're at and what that looks like. And give you a point of reference and comparison for your score. Thomas, why don't you kick us off tonight? And let's start with the most important question is, do the VA guidelines state a minimum credit score anywhere?
No, they do not. The VA does not want to see a number. They want to see a history, a whole profile of how you maintain your credit, specifically over the last 12 months. They want to make sure that, for instance, you don't have any lates, especially with anything related to mortgages. They want to look at your recent history with your housing payments, whether you rent or you live rent free, or maybe you owned a home prior to that. They want to make sure that you're responsible with those payments over the last 2 or 3 years or anything like this.
And that's it's an important distinction. One of the things that we talked about a little bit before we came on air here, at least I was telling Randy, if you go on to YouTube and you're just pulling up videos on FHA or VA, they're very keen to tell you minimum credit score for FHA is 580. No minimum score for a VA loan. Randy, if you get a borrower that has a lower score, let's say a sub 600 credit score, what are some of the implications? So Thomas just told us we got no requirement. We can have that low score, but what changes when you start seeing one of these lower credit scores?
Basically, in a nutshell, the less of a chance, the lower the score, the less of a chance that I'm going to get an automated underwriting approval. And when you when you get an automated approval, when you run the system, set up everything, get your inputs right, and then get your output as an approval, then you're in pretty good shape as far as understanding what's going to work and what's not going to work. The lower you go, the less likely that happens. And then the other thing that I tell my people when I'm talking to them is basically I have 43 different VA lenders at my brokerage, and all of them will go down to 620. I lose about half of them at 619. It's in 20-point bands. I lose another half of them at 599, and I lose all but 5 at 580. So I have 5 that'll go down to 500 or even no FICO, but the pricing goes according to that, because the most competitive workspace is 5 or 620 and above, and then the fewer lenders that are willing to play, the more expensive the pricing is, because they're taking a little bit more risk, because ultimately they're responsible for the decisions that they make, and they want to be, they need to be risk-based compensated for it. So bottom line is the deeper you go, the more hurdles you're going to have to count on jumping to be able to build what they call compensating factors, to say, hey, yeah, the guy's credit score is a little bit lower, but he's got these things that are helping to offset that. And we can go through a list of compensating factors, but basically the deeper you go, the more costly and the more hurdles you're going to have to jump.
We just had a really good question pop up here, and we're going to answer it here in a minute. Wanted to let those come in, but if you have a question at home related to credit scores, improving the scores, how it impacts getting approved, or really anything mortgage or real estate related as it comes to using your VA financing benefit, throw that over there in the chat. We will absolutely get to that. And it's the most important part of the show is answering your questions versus us just going through and sharing knowledge with you. With that, we're all four brokers. If I were to break it out, I'd say it matches up pretty well with what Randy said there, the tiers where we lose half of them. Jerry, what does that start to look like if you have a borrower come to you with a 575 credit score? What does it do for you in terms of options, in terms of putting that file together, and how do you have to prepare that borrower for a different experience than the veteran walking in with an 800 credit score?
I think it starts off with exactly what you just said, which is prepare them. It really comes down to understanding exactly what their circumstances are looking like, their overall picture, and whether or not that is something that can be a hurdle that we can actually get across. Not everyone who comes in can do it right now. It doesn't mean that we can't do it. It just means not right now. And that's not always a bad thing, because unfortunately, what we've seen is that, or at least in my circumstance, right, I've seen a lot more manual underwrites than I have automated approvals over the last, I would say, 3-4 months. I think for every 5 loans that come through, or 5 applications that come through, I think I'm looking potentially at 2 to 3 manual underwrites, because either the FICO scores are too low to where they're not getting that quick and easy automated approval, or we're running into circumstances where like Randy said, compensating factors aren't there, where they don't have any reserves that they potentially may need for a manual underwrite. Whether or not there are, whether or not there's a spouse involved that can actually help with income, even potentially not even be included in the loan, and things of that sort. So you see a diverse really grouping of individuals that will potentially qualify, but potentially may not. And that really makes it difficult depending on the level that some investors are willing to go to now. Some of them that I've been working with for a long time have really started pulling back the reins and really not wanting to push forward with some of these higher LTV or debt to income ratio veterans that are out there, just because they have become a higher risk and there's more chance for default at this moment.
Well, really, so in the context of the show tonight, we're talking about low credit scores. Credit scores are really only one piece of that equation. So when we have low credit scores, it definitely helps when the rest of that file is stronger. Thomas, in addition to credit scores, what are some of the other things that we're falling back on that we could show some additional strength? And Jerry talked about reserves, and we're going to go deeper on compensating factors. But just in general, when you're looking at a file, what are some of the other strengths that can offset a low credit score?
Good question. I would say the lower DTI is a big one. Lenders definitely want to look at that high ratio limit and kind of pull back a little bit if there's some other things that might not be solid, like credit score or whatnot. I know some of the lenders that we work with, most of them stop around 50, and then a couple of them at 55, and then some might even go to 60, which means about half of your income goes towards your housing payment and your credit card debt and your installment loans, student loans, all that stuff is about half your income or so. So I'd say the lower DTI is probably the biggest one that I see right now. Another one is late payments. That there's no late payments in the last 12 months. That's going to be a big one. A lot of lenders, most lenders, almost all lenders want to see 0 lates in the last 12 months. There's a guideline that I just read the other day that kind of leads a lender to believe that 12 months is what they want to see as far as a clean history is concerned. But some lenders might have a different view on that, where maybe if it makes sense. For instance, I had someone who was PCSing from Okinawa to Washington. They had a special needs child. So during that move, they had some auto pay with their car loan and with a credit card bill. And while they were doing their move or planning to move from Okinawa to Washington State, they let one of those payments go. Some credit card or something or debit card expired. They forgot to renew it or whatever. Late payments went over. So that 1 month they had 2 late. So we were able to position it for the lender to look at it and really look at all the risk factors, right? So they have a special needs child. They're responsible parents that are trying to look for a place to make sure their child is set when they move. They're moving from one place to another. Their other history was pretty good. So they look at all that history. And then also the DTI was low to approve that loan ultimately.
And all of those things really circle back to, why are we here? Why do the 4 of us love that VA loan program? It's that the VA is willing to look at a file through the lens of, does this make sense? And are we putting the veteran in a position to succeed? They're not going to just say, hey, we want the veteran to get qualified for a loan, because that may not be the right thing for you, but they do want the right thing for you. If we can make a strong case as to why you are a good credit risk, they're going to do that loan. So we've actually had a couple of really good questions here that relate back to the things that you guys were just saying. Jerry, you covered it a little bit already, so maybe we just start with Randy on this one and kind of go around the horn. First of all, Jerry is seeing more manual underwrites recently. Are you seeing that as well, Randy? And if so, why do you think maybe we're seeing more manual underwrite files now?
I think maybe it's a function of where we're at in the marketplace right now as far as the market flow. And for me, I know that in 2020, 2021, when things were just crazy, you try to spend the same amount of time with everybody, but if you're doing, maximum capacity, etc., it's just sometimes human nature to not spend as much time when you get into the really one, I'd say, tricky, muddy, whatever you want to say, so business is slower, and you're able to take more time and really put the puzzles together for folks is really what I'm seeing. The deals that come across my desk are always valuable to me, but I think when business is a little slower, then you're able to allocate a little bit more resources towards that. And I don't know if that's fair to everybody, but for me, I'm seeing that every deal is valuable, and not that they aren't always as a person, etc. But when you have 30 people that you're trying to help versus 5 people that you're trying to help, you've got a little bit more piece of the pie that you can give them. So I don't know if that's fair.
It's valid and it's good. And let's circle back. Jerry, you were talking before we came on air. Not only are we seeing more of these, just more borrowers in the lower price points. So it's like the middle kind of got carved out. For me here, primarily in Southern California, I cover a lot of the same states as you do, Jerry. But what we see is either these really well-qualified borrowers that, rates are higher and prices are high, but they're so well-qualified, big downs, excellent income, 800 credit scores. They're like, it's the right time in my life to buy, and I can, so I'm going to do it. And then we see on the other end, the folks that, hey, I need to do it. I'm trying to make it work. And what I seem to have lost is the middle deals, the moderate ones. So to me, that's why we either have these slam dunk, easy, like 8-day closes, or we have one that we're working on for 2 months trying to make it work. Is that what you're seeing as well, Jerry?
Yeah, for the most part, I think a lot of the consumers that we're dealing with a lot now, especially, is those who have really been wanting to buy a home, but maybe didn't pull the trigger back when rates were a lot better. And then by the time they started trying, rates started skyrocketing, and then they freaked out and decided, hey, I really don't want to push forward now. And as as time passed and as debt accumulated and things of that sort affected people's qualifying, then they really pulled back because then they realized like, okay, I overextended myself with debt and things of that sort. And so all of a sudden, these people who were maybe sitting in the mid 700 FICOs are now into the middle low 600 FICO ranges, which then at that point, for me, what I've at least seen is once you start getting into that range where you're like at 640 and below, is really where I'm having a hard time trying to get automated approval instantly, right? And so I'm seeing a lot more of those consumers who are right above 51% DTI that are now all of a sudden not able to qualify with automated underwriting. And now we have to look at a manual underwrite. Why? Because that's where the price point is for the area. That's where rates are right now. And this is what they can afford, but it's going to take a little bit of legwork. And so those are kind of some of the obstacles that I've seen, but a lot of it comes down to really what's going on within our marketplaces and whether or not there's a viable opportunity for these individuals to actually get into homes, which is the hard part for many is just getting into a home.
Absolutely. And when you're looking at all of that, Thomas, we had talked about sort of all of those factors coming together in terms of all of these things changing in the automated underwriting system. We see a lot of times Fannie and Freddie are really good about putting out their release. Hey, we're going to have the next release of DU or LP, and we know we're tightening up on loan to value. We're tightening up on debt to income. We're tightening up on FICO. Do we see that? Do we get the same announcements with VA? Do we have that same clarity? And do we think maybe some of this is not just the change in the consumer, but the change in the automated underwriting engine itself?
1,000%. 1,000%. I think that the market in general has sort of repositioned itself to kind of give, in general, not just VA loans, just a little bit more affordability to new home buyers. And then I think with all of those changes in the algorithms that this test that we run all the time comes up with, I think that's really made a big change, just a domino effect, I think, for all consumers, right? And I think VA is just that when it stays quiet when they make the changes, and maybe they're taking notes and they're making these changes and they're just not telling us because that's an inside thing. We don't need to know. We just have to run the test. But like Jerry said, 640, I'm seeing like 41% DTI if it's below like 620. I think there's like a sweet spot that you just have to pay attention to. So it's really, I think, so important to work with a professional who really knows how to kind of navigate through those and knows how to make adjustments to see if you can get an approval. Because so a lot of times you get a refer, which is a manual, basically. And then if you know what to do, increase reserves or maybe pay off a debt or whatever it is, there's some little things that we can do to kind of tweak it to get you into that point. It's really important. I want to say, I think inflation, right, is like the arch enemy of interest rates, but I think that's a big cause of this high credit card debt that everyone is facing right now. Like 80-90% of people are just surviving on credit as a result of maybe or aftermath of COVID, perhaps, or some sort of piece of that. I think all of this is just like that wave, and then just that second wave is kind of coming in and just sort of like washing over it. I think we're in that home stretch where we're going to start to see a lot of that change and maybe underwriting loosen up a little bit. In some situations, I'm seeing that, but I think this is just this 3 years of just us getting a little crazy, partying a little too much with this easy peasy lemon squeezy situation we've all been kind of living in. And now we're just like, all right, we need to pull back. And homeowners insurance has to go up. This has to change. That has to change. There's all these different changes that are happening. That is all about tightening the ship. And I think that's why we're seeing these manual underwrites, that there's so many different factors that people are looking at right now because they've just pinpointed, oh, that's a problem because of this. And this is a problem because of that. I think all those pieces are starting to be looked at just a little more closely now.
Well, we talk a lot here on the show and in the forum about the benefit for veterans to being involved in vetted VA because they can get all these questions answered. They have access to the knowledge, expertise, experience. But this area, talking through what we're all seeing with the automated underwriting engine is one of the huge benefits for us as professionals because it is a full-blown black box. They don't give us, hey, this is, I mean, if it were that simple, A plus B equals C, you could reverse engineer it. We would all know exactly what gets approved and what doesn't. But being able to talk to one another, to call up and say, hey, Randy, what are you seeing? Or have you seen this? Or better yet, throw it out in the private chat there.
Sorry, I want to just kind of point something out that I think we've all seen this, and we've started seeing some of our investors do the same thing, which is we would potentially be running into struggles getting what we call DU or desktop underwrite to approve, right? We'd get a refer eligible result. Then what would happen is that we would keep trying and potentially try what we call LP, which is a loan prospecting system. And that one would actually approve. And what now we're seeing is a lot of our investors are pulling back and saying, "Hey, we're not going to take LP results as an option." And so now it forces us right back into that manual underwrite, which I mean, to a certain extent, I mean, you have to understand these investors are watching out for their risk factors as well. And so looking at those perspectives, you have to understand that this might not be a breezy process. It might be a little rocky. It might take a little extra effort, but that's a lot of the things that you end up seeing now, especially as you go into the higher debt to income ratios. If you're, let's say you're under 50, your likely result of an approval is a lot better than as soon as you go over 50.
Well, let's hold that thought and come back to it, because I think it's really important. It's kind of go through, and maybe we wrap up with that. Anecdotally, what are we seeing? Where is the sweet spot for almost guaranteeing you're going to get the automated approval? But I definitely, before we get too far, I want to get this question answered. So Randy, maybe you can start us off here. Viewer wants to know, if you don't have a credit or if you have a low score, can your loan officer help direct the path to good credit, or is a credit repair company the way to go? So let's say you have a 600 credit score borrower come through. They'd like to get pre-approved. They're not under contract. They're not looking at homes. They want a plan. How do you help? How do you advise? What do you direct them to do to get a score or a better score?
So I would say one of the biggest things for me is obviously number one, the sooner you can talk to a professional, the better off you are, because any loan officer that's worth their salt can help you to navigate that whole process of getting a better score. So we have tools available to us that each one is, we have a automated system that we can pull your credit, and within the first 30 days, then we can look at a couple of different scenarios. One of them is just to see what it would take paying individual accounts down to a targeted amount to raise your scores. The other one, and that's really basic, pretty simple. The other one takes a little bit more expertise, and it's called the what if. So, in that one you go in, you typically, I've already run the first one just to see if there's easy answers. And if the easy answer doesn't present itself, then you go to the what if scenario and you play with things. What if they open another account? What if they, totally get rid of a couple of accounts, etc. And then when you put those two things together, then you can put a plan together that's typically fairly short term, or it could be long term, depending on what the person's scenario is. But it is very, very important that you're dealing with someone that knows what they're doing, and that's willing to take that time and effort to get you to the next point. Because I've worked in call centers way back when, and the call center guys don't necessarily have the time to do that. They don't have the budget, because it's a costly thing for the loan officer that's helping you. That it's not something that we even get reimbursed for. But absolutely. And then I'm a little bit different, I guess, maybe in some regard, as far as a credit repair company. I've been in this business since June of '89. So a little bit over 34 years. And I just haven't seen a lot of credit repair companies that I would have my brother pay. I would rather personally give them the best advice that I can and work through it with them. There might be some things that I'm missing out by doing that, but I've hired a bunch of, or had clients hire a bunch of different ones. And I know that there's a solid one that's a part of Vetted VA, but for me, I just don't send people down that path, because a lot of those companies, they're going to take your money. But one of the things that the components that are involved in the what if and the scenarios is a time frame, and oftentimes, obviously we want to do this as soon as possible, where that we get you in the best scores as soon as possible. But there's a certain amount of time that those negative events will hurt you. And if you can't get them totally taken off, they're going to have less and less of a negative effect on you the farther you go away from when they happened. And so some of the credit things, and this is just me being me, but some of them, I think people pay that, $89 a month for 20 months, when in reality, that 20th month might have been the month that had you not done anything or paid anybody anything, that event, the negativity that was associated with that event on your score would have dropped off anyway. So, I'll let other people weigh in on that fact. But as far as credit repair companies, I think that's a last resort for me. If I'm advising my brother, I'm going to say, keep your money. Let's see what we can do together. And if those results aren't satisfactory, then maybe you go spend your money somewhere else.
Well, Jerry, Thomas, before you guys chime in on that, let me throw in a thought out there and tell me what you guys think about this. Whenever we look at it, I just ask someone, how much time and energy do you have available to pursue this? Because the credit repair companies, they're not magic. They're not doing anything. I mean, there's some unreputable ones out there that are doing some funky things with repeated dispute letters and that. But if we're talking about legitimate credit repair, where they're trying to make permanent improvements to your credit, they're not going to do anything that you cannot do. So the question becomes, do you have the time to do it? Do you have the energy to do it? Will you actually follow through on it? And then kind of where I would say the last part of that, will you actually follow through on it? And to your point, Randy, I have a client that has been in credit repair for 2 years. And I've called them on multiple occasions. It's just stop, just quit. You have not done anything they've told you to do. You've just added another bill in here every month that you pay to these guys. And they come every 90 days. And here's the review. Here's the things we've done. We corrected these things, but you missed another payment. You ran up another bill over here. Why would you pay someone to tell you you are not going where you want to go? So the flip side of that is I've had experiences. I had a client that had a 560 credit score, and in just over 3.5 months, it went to like a 640, and we got the automated approval and got the deal done. So can it work? Does it work? Yes, not for everyone. And that's the beauty of a reputable credit repair company, is they'll tell you, these are the things that you have here. We can fix these. We can't fix these. This is a reasonable expectation of time frame, credit score, and cost. So I gave you guys a little more to react to than I thought. But Jerry, Thomas, does that mesh with what you guys see when looking at credit repair companies?
Yeah, absolutely. I think a lot of it really just comes down to the effectiveness of the individual that's responsible for making these payments. Are you following through with the game plan? There is a structure. There is a plan of action set for you. Now, are you going to fulfill that part of it? Because otherwise, really, I don't want to put you down that path if I know you're going to fail, because you yourself know you're not able to commit to those requirements. Like if you need to make sure that all your bills stay on time, but then you also have to pay X, Y, and Z off, and that's going to bring you hardship, then this may not be a right now situation. This is, like I was saying before about this, it doesn't mean no, it just means not right now. And those are okay to have. Like you cannot have everyone get approved, right? It just doesn't work that way. But if you take your time, and I've had consumers like you where I had them around for 2.5 years, helped them through their credit woes. They had gone through a bankruptcy right beforehand, and then by the time I was helping them, went through a huge process of making sure that they were cleaning up their previous credit history, working on establishing new credit lines, doing a personal line of credit, and it slowly progressing to those better scores, and eventually it resulted in a home purchase. So there are success stories, just as many as there are unfortunately failures, where people think that they could do it and then they just quit. They quit on the process, and they rather get frustrated, because of the frustration they just walk away.
I'd say for me, I'm a big advocate in being a broker, because I'm able to offer options to people. And in order to provide options to people, I have to spend time, having a conversation, getting to know where they're at, where they want to go, before I can even start shopping around for their rate or their option, right? So credit repair is one path, and it's a path that they should understand, and how to get there, what it takes, and how long, whatever that means for them. but I think it's also important to see the other paths and let them make that decision. I think that's so important. I know in one situation, I had someone call me, a realtor that I work with, like 9 o'clock on a Tuesday, 9 p.m. on a Tuesday, and said, "Hey, we just saw this house. We want to put an offer in. I need you to pre-approve this person." I'm like, "Yeah, sure." So I go in my office. I have a conversation with him for an hour and a half. We go through all of his needs, wants, wishes. I get to the point where I'm pulling credit, and it was 570 or something like this. At that point, the most I could approve him for in a market where the minimum house is 450, 400, something like that, and the house they want to make an offer on is like 550. Well, I'm like, "Sorry, you're like 250, something like this. This is about where we're at, but I see a potential here if we do this." Now, we worked really hard, and in 3 months, we had the score go from 570, I think it was 579 to 649. And their pre-approval went up to 550 and change, depending on a couple things. We got him in a house. He closed, but a few months later, I checked in on him, and he wasn't doing well. He took out a line of credit to buy some furniture. What I realized in that situation is that, sure, we can push you through and get into that home and just get you there. But I think it's so important to really like look at all these options and see what we need to do to kind of get you in a position where you can thrive and survive and not stress anymore. Because if you're going through that, I want to fix my credit, or what can I do to get into a home, there might be some things that you need to work through. So I think it's important to have a conversation and to take the time and to kind of, I don't want to say budget, right? Like, look at all the options and see which one is best for you, and then choose to go in that direction, right? Make that choice, and then work together with whoever you're working with, who you've decided to work with, to partner with, to help get you to that point, and trust them to get you there.
Those are really good and really important points. And it was funny. Jerry went one direction, you kind of went another direction, and I've got a third one here, and it kind of relates back to something Randy was talking about earlier. So we can say, a lot of times the question becomes, we can take 90 days and we can work on getting you up over a 640, or we can get this done now, and here's what that looks like. So Randy, if you have someone in that situation, you're saying, okay, here's what it looks like with your 579 credit score. Here's what it looks like if we get you to 625, 645. How do you go through those numbers and advise someone who has some low-hanging fruit on the credit report, some things you could work on, and how do we make that decision if they need to wait or if they should just jump in with the score they have right now?
So sometimes it's simple, and that's one of the biggest things for me. And I have one that's closing tomorrow. That's exactly that story. Is we worked on. He's a turn down from another. Actually, it was a big box lender that had given him approval, and then and then at the last minute they came back and said, "No, you got to. We can't really approve you with that score. You've got to get up to this score." And it was a big, 40-point jump, or had to jump a couple of bands to get there. I was referred him by the realtor, and I just said, "Hey, no, I got an approval for you as is, but if you're willing to do those things, and this is what it costs you, then we can start the process this way. We can price it this way, and I've got it approved this way. But we've got 45 days on this close because of the things, the way that it worked. We'll repull credit again. If you do those things, we'll repull credit again." And 15 days out, we pulled it, and he had jumped 2 bands. And so the pricing was a lot better for him. So it's not that like that's something that you want to do every time. One of the biggest things for me is the decision to be, it's going to cost you this much money to pay for, higher pricing, etc. You may sometimes look at how much is going to cost you to get your scores up by paying down, etc., because that's debt that you paid off versus just paying for a more expensive. If you can save yourself $200 a month by paying off these cards that are already your debt, then it may be worth it. As the overall picture dictates that might be the right way to go. But sometimes it's a timing thing where they don't have the resources to wait. They don't have the resources to do it right now and buy a house right now. And then over time, then sometimes it's a matter of looking at a refinance down the road, as long as you're doing all the right things, etc., because your resources are finite. So it's a little bit different with every person, and you just lay it out to them and say, this is what you've got. This is what it's going to take to get you to here. This is what the difference in cost is. And then letting their response kind of help you guide through the right thing to do for them. And it could be one, the other, or it could be a hybrid, like the guy that I got closing tomorrow, where he had the extra resources and was going to do what the big box had asked him to do, that already set those things in motion. But I would say for me, sometimes it also bites you in the butt, because I had another deal where another lender I was doing a second look and was pricing better and helping them more. And the advice that they gave was to pay off like 38 debts that this lady had. And I would not have done that the way that they asked her to do it, because she was already under contract. And so to pay off the 38 debts is great, but I would have had her do that at close, because of the difference between the paperwork that the processor has to do and all the stuff that you have to come up with for literally, it was 38 debts. And I'm fine with her paying off those 38 debts at closing, because then your underwriter is able to say, we know it happened. Here's our proof and the pudding on the CD. Whereas the 38 debts, tracking down 38 debts and the proof that from the lender that it's been paid, it was one of the biggest pains my processor's been through in forever. So I think you work with the loan officer that tells you the right thing. Again, that was a big box lender that told her, you're going to need to do this. She didn't need to do it. There was other ways around it, but the bottom line is that, they told her in what, in my estimation, was the big pain in the butt way to get it done. Whereas paying them at the CD, in that instance, not when you're trying to affect the score, but this is around debt ratio, pay those debt ratio debts off at closing, and then it's simple.
Yeah, when I'm hearing that, it almost always comes down to these big box lenders have overlays. They're not following the guidelines. They don't have 40 investors like you do to choose from, and they're saying, I have to be at a 45. So you have to pay all of these debts to get to a 45. They don't ever say that we require you to pay off 35 debts. They just say you have to get your VA loan. So it is very important to know the guidelines and reach out for a second opinion. Like the thing that I would say, people always think that second opinion is just a way to get your hooks in someone and try and take a loan from someone. If someone's doing a good job for you, I do not want to take their loan. This is a hard market for all loan originators. If they're giving you good terms, giving you good advice, and have you dialed in optimally, the best thing we can do is just give you peace of mind and say, you're on the right track. Keep doing what you're doing. Jerry, one of the pieces to that, and Randy, maybe if you remember, you have that one that you just closed. If we actually try to quantify it, what is the difference? Someone with that 620 to 640, where we can still get pretty decent terms, versus that 585, 590 score, where we can get it done, but they start getting options limited, maybe not the best pricing, maybe some loan level price adjustments per that lender. What does that look like from most people's end, Jerry?
So I think it just, again, it depends on the full picture, right? At the end of the day. But what I've noticed a lot, what happens is that once you get under that like 640 FICO range, and you get onto like right on the skirts of into the, let's just say the high 40s, low 50s range, those qualified borrowers are seeing a harder time getting the automated approval. Now, once you do get them to get the automated approval, it needs to stay that way, which unfortunately for me, I've seen it happen where even within the last few months with some of the adjustments that have taken place, that I went from having an approved borrower to now having to manually underwrite somebody. And so some of these obstacles become bigger and bigger if, let's just say, they've taken a while to find a home. Let's just say that they took a while to get under contract, and now all of a sudden our credit report's about to expire and we have to pull a new one. Those surprises come into play as well, where now all of a sudden their FICO score drops because they've been overutilized for a longer period of time, and now their scores have been impacted. And so those type of scenarios really start creeping in, at least for me in the current market environment that we've been in. So a lot of it really just comes down to what obstacles present themselves and how easily can we get through some of them. Like you guys mentioned, some of them are quick, easy payoffs. that we could just apply to be closed paid at closing, versus some of them that they really do need to pay now in order to bump up the score to qualify. And then we have to take in consideration is that may delay us from being able to close quickly if the original expectation was to close right away. And so those are just some of the things and that you have to like seriously consider and setting those expectations up front when certain things go sideways as well.
We have another question here, Thomas, and it relates back to the compensating factors and the additional things that you were talking about. Lower debt to income ratio, more likely to get that automated approval despite a lower credit score. But is there an ideal DTI? I get this one all the time, and the answer is there's not. But if someone's asking you, is there an ideal DTI? What advice, what direction do you give them, especially with the VA where with the automated approval, we don't necessarily have a max?
So many factors. Really, I just ask the question, what type of payment are you comfortable with? What do you want to pay every single month? Because at the end of the day, most people forget what their interest rate was, what their DT, none of that stuff matters. At the end of the day, they know how much they got to pay each month for their phone bill, for their car insurance, for their groceries. They know what they have to pay. So a fixed income is more common than anything else, or semi-fixed in this market. But I would say, what's the payment, right? Because your DTI might be 55 and you're good with that. You know, Jerry's might be 35, Randy's might be 20. Mine might be 75. Who knows? You know, it's really dependent on my lifestyle, you know, what I have going on in my life. There's fluctuating income and there's a billion different, like if you're going at a 55 DTI and your income fluctuates throughout the year, that might be really tough, but it might be a lot easier if you're at like a 20 DTI and you have a fluctuating income, because you know those months that it's slower where your income's a lot lower, you don't really have to worry about it because you probably have more than likely have something saved for those slower months. I have to apologize. I have a child who's coming and saying goodnight.
Well, I thought they were saying hello to us, not good night to you.
Okay. Love you. Good night.
So along the same line,
Go.
one of the big things is how much money do you make? Because you go back to the guy that makes $50,000 a month, 50% DTI, he's still got $25,000 left over, right? So if you're $5,000 a month, then if 50% DTI, you've got $2,500. Those are two different ballparks, and not that everybody's going to make $600,000, but still. That's one of the things that comes into play when you talk about DTI. And one of the beautiful things about the VA loan is we go off of residual income. So I've gotten an automated approval before on an 85% DTI, but the guy was making, $20,000 a month and had more than enough. In reality, he had other income that we didn't even come into play. That was, self-employment income on the side that he had, et cetera. And so reality, we couldn't use his spouse's income, because she was newly self-employed and had, another $7 or $8 grand that she was actually bringing in. But the bottom line is that because of the extra income, different DTIs play differently in the real world is my point that you make a look at. Because if you're making $2,500 a month, then, you got $1,200 left. The chances of getting an approval for that are zilch because of the fact that the residual income just doesn't play when you have to take. But if you got $10,000 income and you've got a 60% DTI, you still got $4 grand left over to make things work on, etc. That is a pretty high likelihood that might work. So the DTI is misleading, and that's one of the reasons that the VA loan is a better loan product as far as I'm concerned.
You're not going to get any arguments here. If you wanted to be talked out of it, Randy, you came to the wrong place. We got a couple of good questions here that are off the credit topic, but let's just jump through them real quick. Regina Brown asks, how much of my VA loan entitlement do I have? Is there a set amount or a cap? So hopefully, Regina, you're still here, can give us some clarification because there's a little bit of missing information. But Jerry, what would your answer to that be?
So in this particular question, I would ask first, have you used your entitlement yet? I mean, is this first time use or is it subsequent use? Have you sold the home that you previously had? All these little things will come into play and determine whether or not you have any limit whatsoever, or if you have, already some entitlement in use, and how much do you have remaining for your home purchase. And so there was a post earlier today which actually I went in there, and I think Javier and myself were helping out the veteran do their entitlement calculation. It really depends, because every county is different too. Some of them go just based off of the new conforming loan limits, and some of them are in jumbo markets. So those people will be able to qualify for a heck of a lot more home than, your neighbor next door that might be 2 counties over, but yet all of a sudden they're in a low cost county versus somebody who's in a high cost county. Right. And so those things all come into play. And so those would be like kind of the avenues that I would take in asking those questions, because that's going to determine exactly what their scenario looks like.
That's also a really good trick question to ask someone who tells you that they do a lot of VA loans, but you may be questioning whether they do. Just because that whole bonus entitlement, if someone's not doing a volume of VA loans, they're not going to have any idea how that calculation works, what's possible, what's not. So, Regina, if you've never used it before and you have the full $36,000 of entitlement showing on your COE, you can buy as much as you can qualify for anywhere throughout the United States. There are no loan limits. We did that episode last week on VA jumbo loans, VA jumbo loan limits. There are no loan limits if you have full entitlement. So as Jerry pointed out, it can be much more complicated if you have only partial entitlement. This one is also a little off topic, but a good question. We get this a lot. Thomas, how common is it for loans to be sold even for those with excellent credit? Should this be a factor to look into when shopping for a lender? So 2 pieces there. Does credit impact the likelihood of your lender selling your loan after it closes? And is this something that is in any way controllable where you should try to take it into account when you are choosing a lender?
So generally speaking, the larger the lender, the less likely they are to sell off their loans in shorter periods of time. Majority of lenders, especially in the wholesale channel, are looking to sell those loans off. Some of them will retain the servicing, but right away they're selling off the majority of your loan. It's gone. You're just paying that same person to basically manage your escrow account, if you have an escrow account, pay your taxes and insurance for you. So is it a factor with excellent credit? Really? I mean, it depends. If you have really excellent credit and all you care about, or all you cared about when you were buying your house is the lowest rate possible, and you were working with a mortgage broker, perhaps, maybe they went to the lender with the absolute lowest rate, and they're going to sell that loan off right away. It has nothing to do with you. It just has to do with their portfolio. How much can they hold? Is really how much credit can they tie up? It has nothing to do with you at all.
And it's somewhat of a paradox. Like you said, the big lenders may be more likely to hold it. The smaller lenders, within reason, may also be more likely to hold it because that's their business model. So it comes back to when we're shopping, most of our clients, that's not the biggest factor. The biggest factor is, what are the best terms? Can I get a loan? Can you close on time? Can I have low costs and low rate? And that would generally come after that. And it's not one that's super easy to control. And it's not one that anyone can guarantee you is not going to change after the fact. So it's a tough one to use as a deciding factor in what you're going to do. Well, gentlemen, we've been going for about 48 minutes. We like to keep these to about an hour. We're able to cover most everything related here to credit, but want to just kind of go around the horn and give everyone final thoughts on credit scores and a VA mortgage, buying in the new year, any thoughts, even just New Year's greetings. So, Randy, you're stuck here on the top row with me. You get to go first.
Well, one of the biggest things for me is that, obviously we started out talking about low FICOs, et cetera. And I would tell you that you're not just a credit score. You're a person, and you're not stuck wherever you are. Obviously it's that time of year when people are making the goals for next year, et cetera. Get together, talk to someone that's like anybody on this call or anybody in vetted VA, as far as I'm concerned, and find out, put together a plan for you to go where you want to go. Obviously, we can't control the timing, et cetera, but every one of us can help you to be more than a credit score and your credit score to grow. And any one of us would be honored to help you do that, because You're not what you're much more than your credit score, period. And you earn the benefit. Use it.
Thomas?
Yeah. I don't know. I think I'm just going to stick to happy holidays, everyone. Good luck in 2024, and reach out to a professional, have a conversation, and let them provide you with options you might not even know that you have.
Perfect. How about you, Jerry?
Really, I think just one of the points that I really wanted to make sure that we touched was just the fact that everyone who goes through this process is just like we always say, right? It's like a thumbprint, right? Everyone's fingerprints are different. Everyone's scenario is different. Don't ever think that just because your neighbor next door who got a rate that was awesome means that your scenario is identical. Because there are so many factors, so many differences and variances within your own personal life that will tell you that you are not that person, right? And so when it comes to the process of purchasing a home, know that you're being tailored to specifically. And if you're going to run through these type of scenarios and you're going to have to go through a gauntlet here in order to be successful at your home purchase, then be prepared. And as long as your loan officer or your broker is able to communicate this information over to you and make sure that you understand, hey, these are going to be the obstacles. This may potentially pop up. If they're preparing you, then they're doing right by you. They're making sure that you're being taken care of and that you understand exactly what is going to transpire throughout your process. And if they care enough, they're going to handhold you through that process. So one of the things is that I think for everyone that's listening today is just because you have a lower FICO, don't think that you're out the game, especially right now. Right now is probably the key opportunity for you to get into a home versus later on down the road, because as rates continue to drop, it's going to get harder for everybody because you're going to have that much more competition back in the game, and a lot better qualified buyers, right, with higher FICO scores are going to now be able to step into this arena as well. And that's going to put you behind the line here really quickly. So let's take advantage of those who can do something now and do it. If not, then let's prepare you to be one of those buyers that comes in down the road and is ready to go when rates improve even more.
That number, Jerry, you've seen it as well. For every 1% drop in interest rates, 5 million more American households qualify and are eligible. We only sold 5 million total homes, including new homes, in 2023. So it doesn't mean that all 5 million of them are going to run out and buy. If 10% of them, that's another 500,000 buyers out there to have to compete against. So 100% agree with what you're saying. Now I'm going to contradict it. You had mentioned earlier that the answer is never no. It's not right now. I think over a lifetime, everyone should aspire to become a homeowner, but that doesn't always mean become a homeowner today. In the context of the conversation that we're having today, we went through some really good examples of when you might want to take some time to get your scores dialed in, to improve your finances, because you don't want to be that client that Thomas had, that you did some work in the short run, get into the property, and then go, hey, I don't have enough furniture for a 3-bedroom house. I'm moving out of a 1-bedroom apartment. Hey, I wasn't prepared for this repair, or my husband, girlfriend, wife, whoever wants X improvement in the house and I wasn't ready for it. It is the right thing for everyone to do over a lifetime. It's not always the right thing to do today, and it's not anything you should ever rush, despite the fact that Jerry's 100% correct that it may get tougher as interest rates drop. So do your research, talk to pros that can give you expert advice that are not pushing you into doing it today, but into doing it when it is right for you and facilitating you with all of the tools to make that a reality. So, gentlemen, I appreciate you joining us tonight. Really great insights, great examples of how this actually plays out in the real world. So hopefully if you're watching live, watching on a replay, you got some benefit and value out of this. We're back here every Tuesday with another bunch of pros answering your questions live and going with a deep dive on a topic just like this. So hopefully, again, everyone watching and all three of you gentlemen had a wonderful Christmas. And before we get back here, it will be 2024. So happy New Year's to you watching, and happy New Year's to you three gentlemen and your families.
Same to you, Josh.
All right, gentlemen, we'll talk to you soon.